Hello, everyone. Today on The Final Bar, I'll be talking with Mish Schneider of MarketGauge. We will debrief as much as we can in 30 minutes on Fed Day. 25 basis point hike. Is this the last one? What does this do to risk assets, oil, gold, all of the above and more? Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we debrief on the action of the day using the best practices of technical analysis. The Technical Analysis Toolkit, honestly, is designed to empower you to make sense of days like today, to try to navigate the period leading up to a big announcement, the period afterwards where there tends to be a lot of volatility, a lot of uncertainty as investors try to digest what we just heard. Today, of course, Fed Day. We've got a lot to talk about in 30 minutes. We're going to do our best to get through all of the charts that we can, and a really great guest today. Mish Schneider is going to be joining us live in the studio here in a short while. Let's get to our market recap and talk about what the charts are telling us about the overall conditions today. So today's sort of a fascinating dynamic. If you look at what has happened just in the last 2 days, sort of this V-shaped pattern to yesterday's trading, a choppy, quiet period leading up to the Fed announcement. That's at 2 p.m. Eastern. You get a lot of choppiness, and then the waterfall decline. And we're going to talk about how the day ended, because I think that has meaning, right? There's a reason why you often wait for the closing print to lock in any sort of model, to sort of lock in any key analysis, because that's at the end of the day where the market arrived, right? That is the destination for that trading day, and then we reboot tomorrow and try it again. So what actually happened as stocks sold off into the close? Well, it wasn't good. The S&P, the NASDAQ were actually net positive for much of the day, but really rotated lower after the Powell press conference. S&P down below 4,100, closing at 4090. That's down 0.7%. The NASDAQ composite down 0.5%. Small caps and mid caps were kind of flat for the day. Other than that, everything kind of bad to worse. And again, a lot of that happened going into the last hour of trading. One of the things in the green is the VIX. And if you'll notice here, a couple days ago, we're talking about the VIX down around 16. We're talking about a 15 handle and what that might mean. All of a sudden, we're back to 1850 plus. And that rise in volatility, and again, certainly more upside to be had for volatility if things get more and more choppy, but way off of the lows that we saw here just in the last couple of weeks. So we're starting to come off, potentially off of that sort of low volatility environment. VIX above 20 is the sort of the general back of the envelope number I would look for. And at this point, still relatively muted over time. Interest rates, quite a lot of movement. You saw the yield curve sort of move lower overall by the end of the day, but long bond yields and 10-year yields as well actually moved higher going into the close. End of the day, 10-year yield around 3.4%, 30-year yield just above 3.7%. Short-term yield still pretty high, right? Just above 5%. And that is really the rate that that's not directly the rate that the Fed is controlling. It's something a little shorter than that, but that has more of a direct impact on the short end of the curve. The longer end of the curve is really driven more by the market dynamics of Treasury bonds and where they're going up and down based on auctions, based on supply and demand, and so forth. So we still very much have that inverted yield curve. And again, that's one of the best predictors I was always taught about recessionary periods, which certainly seems to be clear. I would argue that we are in the midst of one, if not sort of plunging into one full go. The TLT up about 0.5%, the dollar index moving down 0.5%. By the way, if you ever want to really think about the relationship between stocks and bonds, and I would encourage you, this is something that I know as an institutional investor, we spend a lot of time thinking about different asset classes. What you want to do is go to Charts and Tools in the upper left corner of our website, go to the dynamic yield curve, which is a simple but beautifully powerful visualization where you can actually put the price in motion. Watch as the S&P goes on and notice in the last couple of years how that yield curve inverts, where the short end is much higher than the longer end. A normal yield curve, go back to like 2021, that's how it's supposed to look, right? Where banks are able to sort of borrow at the short end and lend at the long end. This is not a great environment for certainly a regional bank to survive and thrive, because this is not a successful business model. We'll talk about the regional banks here in a moment. We'll talk about the KRE, which, as you may not be surprised to hear, is certainly going lower recently. Commodity space, we've got commodities mixed, to be honest with you. The DBC, which is a broad commodity ETF, really skewed a little more toward the energy side of the coin, is down about 1.3%. Gold and silver, two of those actually in the green. Gold prices using the GLD was up about 0.8%. We happen to have a former agriculture trader in the house, Mish Schneider, as when we'll talk with her in a little bit. We'll talk about precious metals and see what she thinks about something like gold at all-time highs. What does that mean for prospects going forward? Energy and oil prices, of course, going lower. The energy sector, yet again, the worst out of the 11, down about 1.9% today. We'll try to get into some of those charts as well. Cryptocurrencies, I would say choppy more than anything. At the end of the day, Bitcoin down a bit, about 1%. Ether essentially flat from yesterday. But overall, I would say this is sort of a lighter movement relative to the severe movements we saw in some of the other asset classes that we'll get to here in a moment. Let's look at the chart of the S&P 500. This big, thick green line seems to be more and more meaningful. And it's funny, only a couple times here a year, I make a big, thick green dashed line. That's the Dave Keller indicator, apparently. And when that happens, it's usually pretty important. The last time we did it was this big trend line coming off the 2022 highs. And we talked about how breaking above that trend line was so meaningful. We finally did that in the first month of the year in January, pulled back in March, but then overall remain above there, which is why it certainly has felt like the market has rotated from a distribution phase to more of an accumulation phase. But if you look at where we're at right now versus where we're at, 1, 2, 3, 4, 5, 6 months ago, we're about the same level, right? If you look at late November to late April, it's about the same. And so the issue is, even though there's been a lot of movement, directionally, the major benchmarks are essentially stagnant, right? They're essentially sideways, they're in equilibrium. The problem there for long investors, if you're bullish at this moment, is we were at the upper end of that sort of rectangle, right? Draw a rectangle over the last 6 months. We're at the upper end of this range, up around 41, 4,200. We get down to like 38, 3,900. We're at the lower end of the range, and that's when you most likely could expect some sort of a rotation higher. Interesting to note that we are now in the seasonally weakest part of the year, May through October. May actually tends to be a pretty rough month for stocks after April, which tends to be pretty strong, particularly in a pre-election year. So that is sort of the backdrop to what I think we're seeing as we faced resistance, as the Fed is hiking rates and then talking about the potential of what they might do through the course of the year. The S&P and the major averages are really bumping up against significant resistance. I talked about volatility, so I just want to briefly go to a chart of the VIX and just note the fact that we've bounced higher. I showed earlier in our market recap just how volatility had pumped up a little bit. This is the chart of the VIX for the last couple years, and when you think of on this time frame, we're pretty low, right? We're at the lower end of the range for the VIX over the last 3 years. And that is 100% true. We're actually back down in the range that we were last in 2021. Most of 2021 was spent about in this range. If we go to the last year, though, you can see how we're sort of at the lower end, but just starting to bounce up a little bit here in the last week. This is as the S&P is once again aiming to 4,200. This week, we get a couple downside moves for stocks. We're seeing volatility move higher. VIX gets above 20. All of a sudden, this could feel like a very different market and something more a little uncertain as sort of this traditional fear gauge starts to bubble upward a little bit. Someone asked me just yesterday about banks and how we should think about banks versus regional banks. And my initial answer, I gave a long-winded answer, but my short answer was, it really doesn't matter. They're both going down, right? And remember, my first step when thinking about a group like banks is bring up an ETF, bring up an index that tracks it, and just do the very basic Charles Dow, trend analysis 101 assessment. Is this an uptrend or a downtrend? And when I'm looking at the chart of the KBE, which is the banking ETF, if I look at the chart of the KRE, which is regional banks, there's not a lot of differentiation. Now, there are, one is a little stronger or I guess less weak than the other. But overall, it's sort of like, which of these horrible choices do you want to make right now? They're both going down and they're both showing consistent and I guess chronic weakness. My argument against sort of a bull case for stocks here, can the market go higher without financials being a leading group? Absolutely. Can the markets go higher with banks sort of being choppy sideways and not going up or down? Absolutely. Can the market go materially higher with banks cratering and pushing down and banks failing every couple weeks? I would argue probably not, because that tells you something is happening underneath the hood that is causing a lot of uncertainty in this space. I would feel a lot more optimistic about the markets as a whole if we're not talking about the KBE and the KRE making another 52-week low, which is what we're doing again this week. And it's not the only week we've done that here recently. You know, when we talk about energy, I would say it's certainly a concern. When you look at the chart of the XLE, and we could look at a number of different benchmarks, we could look at MPC like an individual stock. This is an integrated oil name. The MPC is below its 200-day moving average for the first time since over 2 years. It's actually back here in 2000. I think it was 2020 was probably the last time it was below its 200-day moving average. That shows you how much a chart like this has struggled. Now, what you might expect is when we pull back to an ascending 200-day moving average, is finding a bit of support. The problem is with the energy stocks that I would bring up, MPC is just one of them. If you bring up a lot of these charts, they're not really in the finding support mode. They're more in the rotating lower mode. The momentum is overall pretty negative. Instead of stopping at like 40, the RSI is kind of going further downside. The relative strength is certainly not encouraging because it's underperforming other assets and other ETFs that we might be looking at. So I would say energy overall certainly showing some continued weakness. So if that's the case, where are we finding strength? So a couple things to talk about. And again, the apologies how quickly we have to get through all these charts in a brief market recap. There are strong charts out there, and I think what's so fascinating about equity investing and about this market in particular is there are Eli Lillys making new 52-week highs. There are charts like Apple and Microsoft, while granted not making new 52-week highs, they're certainly not at the lower end of the range and continuing to show strength. I would be concerned when some of these mega cap, more defensive technology names like Apple and Microsoft, if those can't get a bid, and you see them not just pull back, which we saw today, but really start to make new swing lows, that's when I think the major benchmarks can be struggling. Until then, we're left with charts like Adobe and other technology names that are failing to break above resistance and now starting to break down through support. The opportunity, I would argue, if you're holding these names, is to think about your risk assessment, think about protecting from potential downside moves. Let's take a quick commercial break. We'll be back with Mish Schneider of MarketGauge. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. I'm excited to bring on my guest today, Mish Schneider, here in a few moments. Before we get there, I want to remind you, we love your feedback on our show. We especially love your questions. We're going to do a mailbag on Friday's show. We love to answer your question live on the air. You can email us at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We are on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. We hope to answer your question live on the air on Friday's show. Upcoming guests. Tomorrow we have T.G. Watkins of Simpler Trading coming to us. He's actually local here in the Seattle area, so we'll bring him in the studio, get some of his thoughts on this market as we digest and continue to digest the Fed move today. Charting Forward is our big market outlook special. We do that once a quarter. Julius DeKempener, Mish Schneider, T.G. Watkins will all be joining me here in the studio. We're going to have a fun conversation about some of the big picture themes that we're looking for. Jay Woods of Freedom Capital Market, Executive Floor Governor of the NYSE, will be joining us on the show on Tuesday, May 9th. I want to welcome on today's guest, Mish Schneider. Mish is the chief strategist at MarketGauge, normally coming to us from Santa Fe, New Mexico, but today we have the pleasure of welcoming you live to our studio. Mish, it is so good to see you again.
Oh, it's such a pleasure to be here. Thank you so much for having me.
The last time we saw you here was for ChartCon 2022 at the last year, which was a ton of fun. A lot's happened, I feel like, in the world and in the market since we last sat down together in person. Fed Day today, a lot of different narratives. Talk us through how you're sort of interpreting what we heard and where we should be focused.
Well, everything that he said was pretty much expected, so there's that. And of course, there was the reaction because I think the market was hoping for a little bit more passivity in terms of what he was going to say. And he said, we may pause, or at least we're near the end. And this was not language the market wanted to hear. So I'd like to step back a little bit from that because you mentioned a couple of things before the show. Number one is you mentioned the fact that we are in this incredibly persistent trading range.
Sure.
And of course, it depends where you look, but if we're looking generally at the three major indices, that's certainly the case. And none of them have been able to really clear the 23-month moving average, which we've looked at before.
That's right, yep.
And that represents expansion beyond a 2-year business cycle. Clearly, we're not seeing that. But also, conversely, we're seeing that the Russell 2000, which is way weaker than the other three indices, hasn't broken down under a 6 to 60 or 6 to 8 year moving average, which we see through the 80-month. So that's going to be the real question. But looking at the bonds for a second, I wanted to really show two different types of bonds because in terms of history, generally yields start falling after May, number one. And in terms of forward yield analysis, both of these are very undervalued. So one would be high corporate grade bonds. And, and obviously that represents some of the bigger companies, the companies that have the better balance sheets. And that's actually holding up pretty well, even though compared to that forward yield analysis, it's down 7% in terms of how undervalued it is.
Okay.
So as bad as the picture looks, and as much of the conversation has been about the banks and how horrible that whole thing is, right now, if it turns out to be undervalued and seasonally accurate, we could actually see those go higher. That would be a positive. And then on the opposite side of the fence, of course, is the high yield junk bonds. And those are the companies that don't have good balance sheets, but yet bond traders buy them because they pay a very high yield. And those two have tested the 50-day moving average. They are over 11% undervalued compared to forward yield analysis. So if both of those things hold up, or one of them do and the other one goes sideways, it would be hard to make the case for a major recession or for things like the SPY breaking down under its 3,800 support, or if it does not for very long.
It's really, really interesting. I mean, so when we're talking about the major averages like the S&P, the NASDAQ, all facing resistance, right, and sort of being unable to break above, the S&P kind of 41 to 4,200, NASDAQ composite as well. You're seeing the same kind of pattern with high yield debt. How important is it for the HYG and J and K, right, those high yield bond ETFs, to break above that resistance? Should we be thinking of it similar way that we would think about with the equity indexes?
I would definitely think of it that way. And Fed funds rate now at 5.25% are where they were in 2006. And if the seasonality does make sense and we start to see any kind of relaxation of the yields from here, and by the way, the 10-year notes are also slightly undervalued compared to where they are historically. So if we start to see anything happen in the yields where they move lower and these two areas of bonds in particular move up outside of the range, I would say that that's probably a good harbinger of perhaps, I'm not saying a sustained rally, but at least not the collapse that people are fearing.
Another chart that you sent was looking at retail, granny retail, I believe we call it, right? And when you're looking at the XRT, we have a daily chart on the left side, a weekly chart on the right side. When you're looking at the retail space, is this an area of the market where you see opportunity or where you see cause for concern, or both?
Well, it's also in a persistent trading range. So the reason why I brought in Granny is because we already know, you've talked about regional banks before I came on, right? And the importance. Well, regional banks have always been part of the family, the prodigal son. And it's amazing how they've taken center stage, obviously, right now. And so I think it's important to note that if this really is the great unraveling based on what's happening with the banking and more of the rural areas, we have to look at the consumer as well. And the same kind of thing, so underperforming what we're seeing, let's say, in growth stocks or in the S&P 500, but yet holding on for dear life to that recessionary line in the sand at around 56 and 60 being pivotal, which it closed above today. So I think just like we were looking at regional banks coming into March, we have to be looking into retail coming into the end of May. The whole sell in May, is it going to be true? It's lots going to be concerning on what happens here with Granny. It's
so interesting how the XRT sort of testing the lower end of the range, but you think of, certainly some components, certainly in this, but like footwear names that come to mind, these just nice, strong, like Skechers and others over these nice, strong trends. How do you think of it in this sort of environment where there's that challenge between the benchmarks that are sort of choppy sideways, a retail ETF that's sort of down at the lower end, but then areas of retail are actually very, very strong? How are investors supposed to get their head around or place the appropriate bets in that sort of environment?
Well, that's a great question, because the reason why we've chosen XRT to represent the consumer is that it has a broad exposure to staples, discretionary, e-commerce, and also brick and mortar. Right. So you've got a good feeling there of what's going on. And yes, I think maybe one of the reasons why she hasn't fallen apart, if I can give her a gender here as grandma, is because of some of the strength pockets that we've seen in some of the staples like a Walmart or some of the food.
Sure.
But you know what's so interesting to me from a consumer instinct standpoint is we just came from Las Vegas and it's packed and people are spending money.
Right.
You know, walking around even here in Redmond, people are out and about. And so there's either a great disconnect of the reality of what the consumers are doing out there and what we're seeing here. And again, I won't get really negative unless we start to see all of the areas, including some of the consumer staples, start to unravel.
People may be walking around Redmond because it's not raining finally, but but that's beside the point. Your point is well taken. You're right. It's pretty odd. We were just in New York last week for the CMT symposium. Same thing. I mean, it was jammed with people. I mean, I didn't see any issues with people spending money. They were out there and spending aggressively. Can we talk about precious metals? You and I have spoken a number of times about gold, about silver. It's been one of the stronger areas of the market for sure. But now we're sort of in this condition where gold is facing, all-time highs, $2,000 an ounce. What do you see with the setup of gold now and looking forward, given all the uncertainty that we see in the markets?
Well, if I may, when I was here in October, ChartCon, that was one of my picks. So I
remember that vividly.
Yes,
it was well said. Yes, agreed. Noted.
And it's not even a matter of being right, but it was really a matter of seeing exactly what gold is doing right now, which is being the ultimate hedge against pretty much all the fear that's out there, and there's quite a list. Yeah. And so looking at gold right now, we had predicted that maybe 2,600 would be a good target, give or take $100. But nonetheless, what gold is really showing right now, and silver, which is interesting because there's the relationship between silver and gold, is that there is a lot of concern in the world, whether the concern be more crises coming from the banks, whether it be geopolitics, whether it be the debt ceiling, although I'm not as concerned about that, whether it be inflation, even though people are starting to say deflation. There's always a possibility that inflation picks up. Core inflation, PCE, is still high, globally high. So I think all these reasons are going to continue to support the gold market. It's hard to chase strength typically, but these dips, which I thought was actually hoping would be a little bit deeper, down to around 1950, didn't happen. Now here we are close to 2050, and if we can get to 2050, you're looking at GLD right there. Then I would say, yeah, I mean, there's certainly more money to be made. Back in the day, people thought, overbought, but commodities are not PE ratios. They are emotional plays, and people want to pile in. Same thing with silver. Also, around 25.50 right now an ounce. The SLV, it was up around 27 in that COVID. It became a meme stock for a minute. Yeah. But now it's showing some real value here. And so to me, look here, it's very hard for me to be convinced that we're heading into deflation.
We only have about 30 seconds left, but I'd love to just ask you briefly about crude oil, because crude oil, of course, dropping significantly this week. Energy stocks, we mentioned in our market recap, continuing to lead the way lower. Is there hope for energy? What would you look for to find an opportunity when crude oil continues to go lower?
Well, it's interesting because not only obviously is that really the one place to look at where you can make the case for some kind of a recession coming. And this is where people are looking to say deflation. But there's also been a lot of bad press for energy and oil on the basis of the fact that a lot of places are mandating that things be switched to alternative energy. Sure. And it's kind of like AI. This could be running a little bit ahead of the actual reality of what that really means by 2025, 2026, or 2035 for that matter. And of course, there could be snags, which would be copper, which we need for EVs and alternative energy. So I would say if we get down much further from here, it'll probably start to look a little bit more tempting. But we have not really looked at the energy space or think that it's the end-all be-all for inflation.
Mish, this has been awesome. I feel like we could spend a couple hours here chatting. We have to keep it at this. Thank you so much for coming in town. It's so good to see you, and have a safe trip home, okay?
Thank you so much, David.
It's Mish Schneider. Mish is the chief strategist at MarketGauge from Santa Fe, New Mexico, joining us here in the studio. Folks, we need to get to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. We're going to start with Spotify. What's interesting about this chart is I'm scanning for stocks making new swing highs and new swing lows. And one area where I'm not finding a lot of new swing highs are technology and communication services. Now, they've had a pretty decent run, but a lot of them have cooled off just a little bit. Spotify is interesting because it's continuing to push higher a little bit. It's actually ranked very, very well in our large cap scooter rankings, 98th percentile, which is not too bad. One of the interesting dynamics on the chart, though, over the last couple months is this bearish momentum divergence. Look at how every new high over the last couple months in Spotify has been met essentially by lower momentum. So a stock moving higher on weaker momentum is usually not an encouraging sign. Now, this can resolve one of two ways. Way number one, the bearish momentum divergence plays out as expected. We start to break down. In this case, probably through the 50-day moving average would be an interesting signal. The momentum gets weaker from here, and it sort of follows through, and we recognize that it was, in fact, rallying on weaker momentum, right? Underneath the hood, not as strong as it might have expected. Option B, though, is we continue to push higher and the momentum improves. This is why on a chart like this with a bearish momentum divergence, it's not a signal on its own, in my opinion. It's what makes you put it on a list. Put it on a list, set alerts, put it on a watch list of stocks in ACP that you will review very regularly, and look for the signal, the trigger that tells you we are exiting that pattern because something is changing. Chart number 2, if we could, is back here. Where is it? Advanced Micro Devices, AMD. When you look at the chart of AMD, you can see that we rallied into what I would call Fibonacci resistance, right? Look at the high in December of 2021. Look in the low of October in 2022. And look at we've rallied about 38.2% of the way up. The semiconductor space, again, over the last 6 months, one of the better places to be. It's hard to find areas that have been as strong as semiconductors. A small group of things like gold, like home builders, right? Some of the mega cap tech names certainly have done just fine. But semiconductors have really stood out with names like NVIDIA showing strength upon further strength. Now, all of a sudden, we're pulling back from a key resistance level. This is where it tested the August high. The S&P's August high is around 4,300, so it's sort of round trip to that, but now pulling back. The gap lower today, down over 9%, is the latest move in a pullback from that Fibonacci level. So what does this chart tell you about the short-term conditions behind AMD? What does it tell you about the overall structure of the trend? So far, we're still making a higher low, but what if that doesn't happen? What if we break below the previous low? What does that tell you about semiconductors as a previous leadership group? Is it still there? I think that's why it's an important chart to watch. Finally, I enjoyed asking Mish Schneider a number of questions, but particularly we talked about crude oil and we talked about the energy sector. I can't help but notice when I'm looking at big movers around this day and yesterday, talking about the Fed meeting, we have crude oil prices gapping lower. This is the USO, so it's a crude oil ETF. You can see the last couple days have really dropped. We're now back to the lows in March. We're sort of within that range that we hammered out at the low there. At the bottom panel, I'm looking at the relative performance of energy versus the S&P. So when people ask me about something like energy, my first assessment is to look at the chart and focus on relative strength. My general initial assessment is, why would I want to own a sector that is consistently underperforming the S&P 500? As our friend Tom Boley has said, if you want to outperform the S&P 500, own things that are outperforming the S&P 500. Areas of the market are doing so, not necessarily energy and not necessarily right now. Folks, that is a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. All of our previous interviews and discussions can be found for free at StockChartsTV.com. I want to thank Mish Schneider of MarketGauge coming up to Redmond, Washington, joining us in our studio and creating some great content. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.